Today, we're going to talk about something that is often hotly discussed and disputed when it comes to planning for retirement. Hold on to your horses here. We're talking about funding the pre-tax versus the Roth 401k account. Now, there's a lot of content out there about one being absolutely better than the other. And really, I think we need to look at this in terms of strengths and opportunities and potential downsides, respectively. No one account is better. It really comes down to your personal situation. So in this video, we're going to talk about things you need to be looking at and consider and discussing with your tax professional and your financial advisor when it comes to funding the types of accounts that you are using as you plan for your retirement. Now that we've established the tax treatment of these respective accounts, why would you fund one as opposed to the other? One of the things that I help my clients evaluate is their expected income taxes, both in their working years and in their retirement. There's going to be certain cases where an individual has very high income in the working years and a much lower expected income need in their retirement. In that particular case, it can be a net benefit to the client to fund the pre-income tax retirement account, because when you put funds into the pre-tax 401k account, it helps shelter money at the highest marginal tax bracket. So let's say this client is in the 32% marginal tax bracket, but in their retirement years, they're expected to be in their 12% marginal tax bracket. On the flip side, if a client has lower marginal taxes now, but in their retirement years, they expect it to be higher because of a pension or whatever it may be, that client could be better off funding the Roth 401k account. So taking a step back and looking at the big picture is incredibly helpful in terms of making a decision of funding one account as opposed to the other. One of the most under-discussed aspects of this all is a concept called asset location. An asset location looks at not just your overall portfolio composition, but where does it make the most sense from a tax perspective to hold certain investments. Now, why is this significant? This is significant because your return is impacted by taxes. It seems rather self-explanatory when you think about it from a global perspective, but it is one of the most under-reviewed components when I'm meeting with new clients. So there's going to be certain investments that you hold within your portfolio that are going to be less tax efficient compared to other investment positions. So looking at strategically where it makes the most sense to hold those assets in terms of an account is incredibly beneficial. Let's take, for example, fixed income or bond positions. Fixed income positions generate income. And as a result, if we hold that in a taxable brokerage account, every single year, we're going to be paying income taxes on that income. Whereas if we were to shift that fixed income position into the pre-tax 401k account, for example, that income that it generates will be tax deferred, and we only pay taxes when we take withdrawals from that pre-income tax retirement account. So big picture, this is a very important component when planning out and constructing your investment portfolio.